Well, joining us now on the line to discuss Fitch Ratings' decision to cut Naspers' debt to junk is Nadim Mohammed from First Avenue. Nadim, hopefully you did get to listen in with our conversation with the CFO of Naspers, who is in China, and says this won't have any significant impact on their lending criteria going forward. So maybe Fitch made a wrong call because it's not even impacting on the share price.
Yeah, I think it was a bit of a harsh decision, and it was really interesting how the share price moved today. So in the morning we had Naspers down approximately 2% on the Fitch rating review, and then we saw Tencent's results for the quarter come out, and they're extremely good, beating most estimates on almost all the measures that they released. So then Naspers turned the other way and went up 2.15% for the day. So interesting there. But I agree with the CFO that it'll have very little impact in terms of their financing and their structures. Also, I think it was a very it was a bit too harsh on Naspers, because if you think about them, their listed assets just in Mail.ru and Tencent in China are worth something like 55 billion. So those are shares that they can liquidate at any point in time. And the net debt position is just $1.5 billion. So, you know, in my opinion, there's no serious default risk there.
It's crazy, isn't it, Nadim? Because if they sold 3% of their stake in Mail.ru and Tencent, which they wouldn't do, or not to just get the ratings agency sorted out, but that would wipe out all of the debt, and then they'd give presumably a AAA rating. But it was interesting that Basil Skoros said to us they have their budgets for the next 3 to 5 years. They don't need to borrow anyway. So what's the point of having a Fitch rating?
Yeah, the point of that Fitch rating is only if they, if they do need to borrow money in the future, and they're actually quite well funded. I mean, I think they have a 7-year bullet structure that expires in 2017 and one in 2020. So, and that covers most of most of their requirements for now. Also, they get a very big dividend from Tencent each year, and I think with the way Tencent is growing, that may increase in time to come also. But if you look at the nature of Naspers, the reason why their earnings have been a bit low in the last few results was because they've drastically increased their development spend, and it's at a peak right now. And at any point in time, they can decide to reduce that. So if it is going to compromise earnings, or if they don't have enough capital to invest in development spend. So, but the trouble is, because being an internet company, that has to be expensed from the income statement. So whereas if it was another type of company, it may well be classified as capital expenditure. So that's why the earnings sometimes look really compressed, and the PE ratio looks sky high. But it's purely because of this aspect of how much development spend you're going to invest in a year.
Nadim, just on Tencent's update out today, as we heard Alec mention at the top of the show, increasing growth there from 59% on a year-on-year basis. Does this also highlight again that once again exponential growth is something that the market still has to come to terms with?
I've been very bullish on Tencent for a very long time, and I think this move to mobile just cements their position even further. I was looking at the results today. I mean, if you look at the user base between what we call WeChat or Weixin, and if you look at, they have another one called Mobile QQ. I mean, that's over 1 billion users on their mobile platform, and that's most of the Chinese internet population. And so they're dominating this, and they're just starting to monetize it through games and e-commerce and all kinds of interesting applications. I mean, I think right now, we're very much in the growth phase of Tencent. So it looks like a very, very exciting opportunity from my perspective.
It's interesting that today Naspers' market cap has gone through 600 billion rand, and the company that it's often compared with, Richemont, not least because of the Becker and Rupert kind of factor. They both live in Stellenbosch, or near to Stellenbosch. Richemont, which is a much older company, my apologies, it's not much older, but it was much bigger until fairly recently. Richemont is today worth 530 billion. So Naspers has overtaken Richemont, heading towards becoming maybe the biggest company listed on the JSE at some point in future. I guess that would depend on Tencent, though, Nadim.
Yeah, and if you look back in time, I mean, it was an investment of I think it was $20 or $30 million. I might be wrong. that Grossbecker made, back in the day, in the sort of late in the early 2000s or late 90s, and that's compounded so much that it's the majority of their market cap today. So it's amazing what that investment has achieved, and also that South African investors have been given an opportunity to participate in this.
I've been doing some research on that one. It's a lovely story. In 2001, they wrote off, Naspers they wrote off $80 million on a Chinese ISP that they'd bought. They bought it in 1998. 3 years later, they had to write it off totally. And at the same time, they went and made this investment into Tencent of $46 million. So if you talk about grit, you talk about guts, you talk about the belief in their own business model. And most companies would have said, oh my goodness, are we losing money in China? Let's stay away. But they went and put another $46 million into Tencent, bought 50% of it. And as Nadim was saying, it's now worth more than the market cap of Naspers as a whole. Extraordinary story.
Certainly takes a lot of guts there, Aleka. But thank you so much to Nadim Mohammed from First Avenue for updating us there on the latest regarding Naspers.